Financial institutions are continuing to improve the way they manage the risk of paying compensation, but they say more work needs to be done. At least that's according to a new survey from Deloitte. Edward Hida is the editor of that report. He's also global leader of risk and capital management, as well as a partner at Deloitte Touche. He joins us now to discuss the findings. Sir, thanks so much for joining us here on Bloomberg's Bottom Line.
Thanks. Happy to be here.
Seventh edition of the report. Give us a sense of what some of the highlights were.
Yeah, I think there's really three things that we can look at from the report overall. One is risk governance, and by that I mean the system by which the organizations manage and oversee the risk management process, and that's been strengthened in the last number of years. We look at things like the so-called chief risk officer, the individual responsible for managing risk. The number of organizations that have a chief risk officer, CRO, is up. It's up to 86%. That's the highest since we've been tracking it.
Was this because a direct result of the financial crisis, and a lot of people said some people were asleep at the switch during that time?
I think what we've seen generally is a strengthening of this risk governance, and there's a number of reasons for that. Certainly there's more regulatory focus on it. Organizations also have been enhancing that themselves. Another element to that is the oversight by boards, and of those chief risk officers, 85% now report into the CEO or the board. So there's much more involvement by the boards and top management in overseeing the chief risk officer. A couple other points that I wanted to make in terms of overall highlights, if you will. One is related to the risk infrastructure, and by that I mean the systems and the data that underlie the risk management analyses and processes. That's an area, frankly, where more work needs to be done. We asked organizations how happy they were with the data that underlies some of their risk analyses and calculations, and less than half were satisfied, if you will, with the risk data that underlies that. So clearly more work to be done in that area.
What do they need to do to improve that?
They're working on a number of things to improve their data. One of the elements that they're working on is getting what's called a single view of the customer, so that they can look at the exposure from different counterparties or customers across the organization. So they're really looking at internal ways to assess the risk in a better manner. That's a big focus right now, looking at and enhancing that data.
I was noting, because some of the information I got, you say that it's even more important that financial institutions take risk management into account in performance evaluations and incentive compensation across the organization. And you continued, because all of the attention the issue has received around the globe, there is considerable work to be done here. Even given what we went through with the economy and the economic downturn, and even with new regulations that are on the books, Dodd-Frank, just to name a few, are some of these firms, are they getting the sense that it's not just in their interest, but it's in the overall economic interest for this to be evaluated, and to be evaluated closely?
Well, I think organizations are definitely getting the message that they need to build in more what I would call risk-based incentive compensation, so to build in those risk considerations into compensation. When we looked at that, only 37% of institutions overall had done that. And when we looked further into that by areas, that was mostly at the executive level, where close to 60% had built in risk-based incentive comp. But when we got into areas like middle management, finance, operations across the organization, those percentages fell down.
Why is that?
I think it's a case of really needing to embed these principles throughout the organization. So organizations had focused on the top of the house and executive comp, and building in that risk-based incentive comp at the top of the house, but where they need to do is to further extend that throughout the organization. So there's more work to be done there.
How has the role of the chief risk officer changed?
Yeah, one area, as I mentioned, that's changed there is more seniority, more senior reporting. They're also more actively engaged with the board. We've seen that boards who meet independently with the chief risk officer is also up, and that's up notably from the prior survey. So there's more access by the chief risk officer to the boards, and more effective engagement at that level.
Is the chief risk officer, in a sense, the ombudsman? Is this the person who is just looking out for the best interest of the company and perhaps even the shareholders?
The chief risk officer should be looking at the overall risks of the organization and looking at that from an overall comprehensive way. So they're really tasked with being the person who's overseeing all of those risks, making sure that that risk program's in place, and making sure that senior management's engaged and the board's engaged with that process as well. So they do serve that role.
Going forward then, what might we see? If you could differentiate maybe this year's surveys from last year's survey, what did you see? What significant changes did you see?
Yeah. The increase in risk governance was definitely an area that we noticed, and a lot of focus there, I think, over the last several years. Also, the focus on some of the specific techniques like stress testing picked up, but as I mentioned, that whole area of infrastructure, work has been done, but more work needs to be done on improving risk infrastructure and the underlying data.
And quickly, how many institutions took part in this survey?
130 institutions globally.
Assets of what?
Assets of over $17 trillion.
Wow. Edward Hida of Deloitte joining us now with the latest risk management survey. Mr. Hida, thanks so much for coming in. We appreciate it. Thank you.